Hey everyone, welcome back to Corporate Decoder, the place where we break down the boring business filings so you don't have to. Today we are diving deep into Compass Minerals International's latest quarterly report, and let me tell you, there's a lot going on behind the scenes with this essential minerals company. Stick around because we're going to uncover how their business is really doing. Let's start by taking a quick look at their financial health. As of June 30th, 2025, Compass Minerals had total assets of about $1.5 billion. That's down slightly from about $1.6 billion at the end of their previous fiscal year in September 2024. This decrease seems largely driven by a reduction in intangible assets and goodwill, which makes sense given what we'll discuss later about their exiting certain business lines. On the flip side, their cash and cash equivalents saw a nice bump up to nearly $80 million from just over $20 million. That's always a good sign, showing they have more readily available cash. Now for the top line sales figures. For the 3 months ending June 30th, 2025, Compass Minerals brought in around $215 million. That's up from $2,030 million in the same period last year. Looking at the 9-month period ending June 30th, 2025, sales were about $1 billion, a solid increase from $99 million in the prior year. This growth is pretty encouraging. Digging into profitability specifically, the gross profit for the 3 months ending June 30th, 2025 was about $41 million. That's a nice jump from $33 million in the same period last year. However, for the 9-month period, their gross profit actually decreased to $152 million from $76 million in the prior year. This means while they sold more overall, their costs went up faster than their prices, which is definitely something to watch. Operating expenses also played a role. Selling general and administrative expenses for the 3 months ended June 30th, 2025 were about $24 million, a decrease from about $27 million, the $87 million. This is likely a result of their cost-cutting initiatives we heard about. But here's where things get interesting. The company recorded a loss on impairments, net of about $54 million for the 9 months ending June 30th, 2025. For the same period in the prior year, that number was much higher at $1,733 million. This significant impairment is tied to their decision to exit the Fortress fire retardant business, a move that cost them dearly but seems to be a step towards streamlining operations. They also had a substantial loss on extinguishment of debt of about $7.6 million in the third quarter of fiscal 2025. This was related to refinancing their debt, paying off some loans and issuing new notes, which is a common but often costly maneuver. All of these factors combined led to a net loss of about $17 million for the 3 months ended June 30th, 2025. For the longer 9-month period, the net loss was around $73 million. While no one likes to see losses, the key here is that the net loss narrowed significantly compared to the prior year's 9-month loss of over $157 million. So despite some costly adjustments, the company is heading in a better direction financially. Let's talk about their different business segments. The plant nutrition segment is showing some real promise. Sales for plant nutrition were up about 15% in the quarter to almost $45 million and up 19% for the 9-month period to over $164 million. Sales volumes are up too, which is great to see. Their average sales price per ton, however, has decreased, which is a headwind, but the overall volume growth is a strong positive sign for this part of their business. The salt segment also saw sales increase by about 3% in the quarter to $166 million. For the 9-month period, salt sales jumped 13% to over $840 million. This was driven by higher sales volumes, particularly in highway de-icing salt, which makes sense given more winter weather events they mentioned. However, average salt sales prices dipped slightly, which continues to put pressure on their margins. Despite the pressure on salt prices, their salt operating earnings actually increased slightly in the quarter to $28 million from about $26 million. For the 9-month period, however, salt operating earnings declined to $123.4 million from $143 million for $14.3 million versus the prior year. This indicates that while they are selling more salt, the increased costs are eating into their profits. Looking at other comprehensive income or loss, the company has an accumulated other comprehensive loss of about $96.6 million as of June 30th, 2025. This figure represents unrealized gains and losses, most notably foreign currency translation adjustments and other items that haven't yet impacted their earnings. It's a way to account for value changes in things like your investments or currency holdings. A large portion of that loss is from foreign currency translation adjustments. So as the dollar strengthens against other currencies, it can create these paper losses. When we look at how they value certain assets and liabilities, we see they primarily use observable market inputs or level 2 inputs. For things like their derivatives, this is good because it means their valuations are based on real market data and not just internal guesses. For their debt, the 8% senior notes due in 2030 are valued at about $671 million, which is higher than their carrying value of $650 million. This implies the market sees these notes as more valuable than their face value, which can be a good sign. For DFUA are bid at about $651 million, which is higher than their carrying value of $605 million. This implies the market sees these notes as more valuable than their face value, which can be a good sign for their creditworthiness. Speaking of debt, a major event for Compass Minerals was the issuance of $650 million in 8% senior notes due in 2030 on June 16, 2025. This was a significant financing move used to pay off other debt like their term loan and revolving credit facility, and even redeem some of their 2027 notes. This refinancing is aimed at improving their debt structure and reducing interest costs over the long run. They also amended their credit agreement on June 16, 2025. This amendment adjusted their financial covenants, making them a bit less restrictive. For instance, they changed their leverage ratio requirements, which is common when a company takes on new debt. This shows they are actively managing their debt obligations and adapting to their financial strategy. Now let's touch on some legal matters. Compass Minerals is involved in several lawsuits, including a securities class action that was settled for $48 million. They also had shareholder derivative lawsuits and a securities class action related to their Fortress business. While these are significant, they mention their insurers are covering the costs and they believe the outcomes won't materially hurt their finances, except where noted. It's important to note a lot of these legal issues stem from past reporting or business decisions. The company also highlights numerous risks in their report. These include things like weather conditions, competition, supply chain issues, and of course, regulatory compliance. A key risk they continually mention is the impact of weather on their de-icing salt sales, which is a core part of their business. Also, they note the potential impact of climate change on everything from snowfall to the brine levels at their Ogden facility, affecting their salt and plant nutrition businesses, respectively. A really crucial disclosure here is the ongoing issue with their internal controls over financial reporting. They acknowledge material weaknesses, meaning there's a reasonable chance a big accounting mistake could happen and not be caught in time. They've hired more accounting staff and are implementing new processes to fix this. While they state their latest financial statements are presented fairly, it's a reminder that accounting accuracy is a constant challenge and a material weakness can be a red flag. So what's the story here? Compass Minerals is a company in transition. They are exiting a struggling business line, the Fortress fire retardant business, which has incurred significant impairment charges, but they are also growing their core salt and plant nutrition segments. The plant nutrition business looks particularly strong with rising sales volumes. They've also proactively managed their debt structure through refinancing. However, the ongoing issues with internal controls are a concern that investors will want to monitor closely. Looking at the numbers, the increase in sales and improved net loss are positive signs. The segment performance suggests they are focusing on the right areas for growth. The lower SG&A expenses show good cost management. However, the dip in gross margins for both segments is a concern, indicating rising costs are a real issue. They are definitely navigating some headwinds, but their strategic moves seem to be positioning them better for the future. That's our deep dive into Compass Minerals International's latest financial report. What do you think about their exit from the fire retardant business and their focus on core operations? Let us know in the comments below if you found this breakdown helpful. Please hit that like button and subscribe for more corporate insights. And hey, don't forget to join our Discord community, linked in the description for even more discussions. Thanks for tuning in to Corporate Decoder. See you next time.